Imagine your business is expanding across 3 countries, each with its own unique tax regulations. Without expert guidance, your business could easily face double taxation, compliance challenges, and missed tax savings opportunities, which could cost you millions. In today's video, we will explore cross-border taxation and explain the crucial role that tax advisors play in helping companies stay compliant and financially efficient in the global market. If you are a tax advisor or just someone intrigued by international business operations, in this video, you will learn the essentials of cross-border tax advisory and what makes it so critical for global business success.
Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos.
Let us start with the basics. Why is cross-border taxation so challenging? Well, each country has its own unique tax system, which includes different tax rates, filing deadlines, and definitions of income. For companies operating in multiple countries, this means juggling a variety of tax laws, each with its requirements. Imagine a company doing business in 5 different countries. They might face the challenge of double taxation, which means the income generated in one country is taxed again in another country. Or they might need to address transfer pricing rules, which basically means setting prices between their own subsidiaries in different locations. Also, as the global tax environment is continually changing, new compliance requirements and reporting standards might be introduced, which will impact how multinational companies manage and report cross-border transactions. Without a proper strategy, these challenges can eat into profits and create a huge compliance burden. And that is where tax advisors come in. They help companies make sense of this maze and find a clear path forward. Now, let us explain the role of tax advisors in cross-border taxation. This can be broken down into 4 main roles, which include 1. Tax compliance and risk management. Advisors help businesses comply with tax regulations in multiple countries, ensuring that businesses meet all tax filing requirements, avoid penalties, and minimize risk exposure. They also establish tax risk management frameworks to monitor ongoing compliance across jurisdictions, ensuring the business does not run into trouble with tax authorities. Tax structuring and optimization. Advisors analyze companies' operations, transaction flows, and entity structures to recommend adjustments for enhancing tax efficiency while ensuring compliance with international tax laws. Such recommendations could include establishing holding companies in tax-friendly jurisdictions, utilizing treaty benefits to minimize withholding taxes, or adopting tax-efficient vehicles for cross-border investments. 3. Representation with tax authorities. When tax authorities have questions or concerns, advisors act as the business advocates. They prepare responses to inquiries, compile documentation for audits, and even represent the company in disputes or litigations. 4. Due diligence in cross-border mergers and acquisition. In cross-border mergers and acquisitions transactions, advisors assess the target company's tax liabilities, existing disputes, and transfer pricing practices to identify potential risks or benefits. This analysis helps determine whether the acquisition should be structured as an asset purchase, which limits tax liabilities, or as a share purchase, which may inherit the target's existing tax position. Advisors also develop integration strategies to align the new entity structure with the parent company's goals. Now, let us look at a couple of real-world examples to understand the impact of these roles better. Case study 1. Structuring for tax efficiency in an international expansion. A US-based technology company planning to expand into European and Asian markets, each with its own unique tax rates, withholding tax regulations, and reporting standards, engaged a tax advisor to develop a tax-efficient structure that minimized liabilities and ensured compliance across jurisdictions. In Europe, the advisor recommended establishing a headquarters in Ireland to take advantage of favorable corporate tax rates and reduce withholding taxes on royalties and dividends, facilitating access to the market. For Asia, the advisor suggested setting up a holding company in Singapore, leveraging tax incentives and exemptions to optimize regional operations. The advisor also assisted in preparing transfer pricing documentation to mitigate risk associated with intra-company transactions. The outcome: the company successfully expanded internationally with a tax-sufficient structure that minimized tax exposure and ensured compliance across jurisdictions. Case study 2. Navigating a cross-border merger. A Nigerian manufacturing firm planning to acquire a French company for market expansion and advanced technology identified several tax considerations during due diligence, including deferred tax assets in France and potential transfer pricing adjustments on intercompany royalties. The tax advisor thoroughly reviewed the target tax position and uncovered risks that could affect the firm's finances. Based on the findings, the advisor recommended structuring the acquisition as an asset purchase rather than a share purchase to minimize the risk of unforeseen tax costs. The advisor also designed an integration strategy to streamline intercompany transactions, establish a robust transfer pricing framework, and ensure that the merged entity's tax structure was optimized for long-term efficiency. The outcome: the Nigerian firm successfully acquired the French company without inheriting unwanted tax liabilities, achieving tax savings and smooth integration with a tax-efficient structure. In conclusion, engaging tax advisors in cross-border transactions profoundly enhances a business' ability to succeed in the global market. Their expertise helps ensure compliance with diverse regulations and fosters strategic planning that optimizes transaction structure while mitigating risk. By leveraging their knowledge, businesses can achieve significant cost savings and maintain operational efficiency, ultimately positioning themselves for sustainable growth and success. As such, tax advisors are essential partners in navigating the intricacies of cross-border taxation and seizing global opportunities, ultimately driving business success. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.